In the 5 weeks following April 3, 2025, institutional rebalancing flows moved in the opposite direction to retail sentiment. The institutions were buyers. The retail investors calling their platforms were sellers. That pattern has repeated in every correction I observed in 31 years. 4 investors, 1 crashing market, 3 completely different opinions, 4 people, 1 hour, and a data set that shows the gap between what investors think they should do and what the evidence says they should do has not been wider. This panel covers Series 2, 6 episodes on the building blocks of financial resilience, the emergency fund, compound timing, debt clearance, the index fund purchase, and automation. Then the market tested all 6 in a single week. Kai, 28, has been investing for 2 series, set up his first direct debit in episode 6, cleared his credit card debt in episode 8, watched the April 2005 correction happen in real time while his direct debit ran automatically. Maya, 35, built her first million through 9 years of index investing, lost it at 40 following a financial advisor, rebuilt it at 44. Her one rule for corrections: close the app. Nadia, financial journalist, 11 years, she covers the Morningstar Mind the Gap study every year. Most financial journalists do not know what it is. Marcus, senior director of institutional investments, 31 years. He was managing a portfolio when the markets opened on April 3, 2025. Same 6 episodes, 4 completely different reactions to what happened next. This is the panel. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions. Series 2 built 6 foundations before the market moved. Episode 6, the emergency fund. The thing that means you do not have to sell investments in an emergency. Episode 8, clearing high-interest debt before investing. The structural preparation. Episode 9, the single index fund purchase. 1 ticker, 3,500 companies, 0.22% annual fee. Source, Vanguard 2000. The panel has had time to watch what happened when a 9% correction, source, Reuters, Bloomberg, April 2005, tested all 3 simultaneously. They do not all agree on what it proved. Let us find out where. If you have noticed a pattern across 9 episodes, the people who build wealth are not the ones who find the perfect investment, they are the ones who set it up and leave it alone. Subscribe. The next episodes continue this. The Morningstar Mind the Gap study tracks the gap between what investment funds returned and what the investors in those funds actually earned. Source: Morningstar, 2000-30. Over the 10-year period ending 2000-2022, the average U.S. investor earned 1.7% less per year, same source, than the funds they were invested in. Not from poor fund selection, not from high fees. From timing decisions, 1.7% per year. Source: Morningstar Mind the Gap Study 2023. From decisions made during moments precisely like April 2025. This is the gap. Fund returns on top, investor returns below. The space between them is not the market. It is not the economy. It is a decision made during moments of volatility to buy high, sell low, or stop contributing. That 1.7%, source Morningstar 2000-2003 figure is lower than the equivalent gap in institutional mandates. The mandates prevent the decision. The retail investor has no mandate. They have to build the equivalent architecture themselves. Most do not. The architecture is what episode 9 described. Set it up, make it automatic, then leave it to run. When the direct debit runs automatically on the first each month, there is no timing decision. The architecture removes the gap Morningstar is measuring. My direct debit ran on April 1st, 2 days before the correction started. It bought units at the pre-correction price. Then the correction happened. Then it ran again on May 1st, at the lower price. I did not make a decision in April. The architecture made it for me, twice. What the Morningstar data, source, Morningstar 2023 identifies as not a knowledge problem. The 1.7%, source Morningstar 2023, annual timing gap exists across investors who know the DALBAR data, who know the SPIVA data, and who have been investing for years. The gap is a decision architecture problem. Most investment platforms are designed for active use. Notifications, balance updates, performance comparisons. Every feature of the interface is designed to generate a decision moment. The investor who does not interact with the platform loses nothing. The investor who responds to every notification makes the timing errors the Morningstar data captures. The question this series does not fully resolve is why investment platforms are not designed for inaction. That is the question I want the panel to answer. Investment platforms are not designed for inaction because inaction does not generate revenue. The business model of an active trading platform depends on transaction volume. The business model of a passive index platform depends on assets under management. Those are structurally different products. VWRL at 0.22%, source Vanguard 2024, does not reward the platform for generating trading activity. An active platform at 0.5% commission per trade, source Illustrative Industry Average, FCA Fee Data 2022, does. Nadia's question has an answer. The answer is not encouraging. I am going to agree with Marcus and then take a different direction. Yes, the platform design problem is real. The business model problem is real. But the investor who is sitting at home in April watching the market fall is not thinking about platform business models. They are thinking about whether they should sell. The solution to that question is not platform redesign. It is having made the decision before the moment arrives. The architecture Maya described in episode 9, the direct debit, the separate account, the deliberate inaction, is available right now. It does not require a platform to change its design. The question is not whether the system is imperfect. The question is what you do while it is. I checked my balance 17 times in April. Not 7, 17. I knew the DALBAR data. I had scripted the panic selling episode. I understood what the Morningstar gap was before this panel. Source? Morningstar 2000. And I still checked 17 times, I just did not act. So my question, which I think is the actual question, is not why platforms generate decisions. My question is, how does someone who knows all of this still feel the urge to act? And is knowing it enough? Right, quick one. 30 seconds, stay with us, because this is the part most people never hear. While the panel was preparing, we read every viewer comment across Series 2. The most common question was not about which fund to buy. It was not about when to start. It was this: I know I should not sell, but in the moment, how do I actually not sell? 4 panelists, 1 question, all 4 answered differently. You are about to hear all 4 answers. Right, back into it. Deep Dive 1, Episode 6 and Episode 9 together. Maya. The emergency fund and the automated index fund purchase are designed as a system. The emergency fund means you do not have to sell the investment. The automated investment means the decision is made before the crisis arrives. In April, the investors with both in place had nothing to decide. The system ran. Nadia, the timing gap is 1.7% per year, source Morningstar Mind the Gap Study 2023. The emergency fund and automation architecture eliminates that gap mechanically, not through discipline, through design. Marcus, I spent 31 years watching professional investors fail to maintain discipline during corrections. The mandates that force them to hold are the institutional equivalent of the direct debit. The individual investor has to build that mandate themselves. When they do, they perform equivalently. Kai, I had both. The emergency fund from episode 6, the direct debit from episode 9. In April, I had nothing to decide. I checked 17 times, I decided nothing. The system decided for me. Deep Dive 2, the gap Nadia raised in Block 5. Nadia, during the April 2000-2005 correction, every major UK financial media outlet published coverage advising investors to review their portfolios, or consider their risk tolerance. I tracked 47 pieces across 12 publications in 14 days. Not one piece recommended continuing automated contributions without change. What does not exist in any public record, and I have looked, is a documented study of the correlation between financial media coverage of corrections and retail investor timing decisions. The Morningstar gap is documented. Source, Morningstar 2023. The media coverage that precedes the timing decisions, its causal relationship with those decisions, is not documented in any Tier 1 public study I have found. Marcus, I am not in a position to speak to what internal research exists on this question. What I can confirm is that no publicly available institutional study documents the relationship between financial media correction coverage and retail investor outcomes. Kai, right. So nobody actually knows whether the coverage makes it worse. That is going in the notes. I've 3, the genuine disagreement. Maya, the answer to the viewer question, how do I actually not sell, is architecture. Set up the direct debit before the crisis. That is the answer. It is not a discipline answer. It is a design answer. Nadia, I agree with the practical answer. Where I disagree is the framing. The Morningstar data, source, Morningstar 2000-2003, shows the timing gap has not narrowed in 10 years despite a decade of index fund awareness growing. If the answer were architecture, we would see the gap closing as more investors automate. We do not. The gap is structural and persistent. Marcus, the gap will close when the cost of the timing decision is made as visible as the cost of the fund fee. Fund fees are disclosed because regulation requires it. Timing costs are not disclosed because no regulation requires it. That is where the leverage is. Nadia, that is the first time I have heard Marcus identify a regulatory lever he agrees with. Marcus, I did not say I agreed with it. While the panel was preparing, Kai submitted one question in writing. He asked it last because he wanted to hear everything else first. Every person I know who checked their balance in April felt the urge to do something, including me, including people who knew all the data. So my question is not about architecture. It is more basic than that. If you are sitting there in April watching the numbers go red and you know you should not sell, what actually goes through your mind? What is the actual internal experience of not selling? The first time, it was the worst week of my investing life. The second time, I had the direct debit and the emergency fund. The market fell 18%, source MSCI World Net Return Index 2022, in 2022. My balance was down. My contributions were running. The emergency fund meant I did not need to access the investment. The system had removed the decision. The internal experience was, I noticed the balance. I felt the urge. I had nothing to act on. After 3 days, the urge went away. After 11 months, the balance had recovered. The architecture did not make the urge disappear. It made the urge pointless. Do it once. Make it automatic. Then leave it to run. The Morningstar research includes qualitative data on investor decision-making during corrections. Source: Morningstar 2000-2000. The most common description is not panic. It is discomfort at inaction. The feeling that doing nothing is irresponsible. The framing of inaction as negligence is one of the most persistent and financially damaging cognitive errors in retail investing. Doing nothing during a correction, when your investment is automated and your emergency fund is intact, is not negligence. It is the strategy. The strategy requires no action. The internal experience of not selling is accepting that the discomfort of inaction is not the same as the cost of inaction. In March 2020, I watched fund managers with 30 years of experience reach for the sell button. The ones who did not sell had one thing in common. They had written down their investment thesis before the correction began, not during it, before it. The internal experience of not selling is reading something you wrote when you were calm that tells you what to do when you are not. Kai, I did not write anything down, but I had 9 episodes of scripted content explaining what to do. I reread episode 4 in April. Twice. Right, that just went in. Each panelist, one thing. Marcus, write your investment thesis before the correction. Not during it. The document you write when calm is the document that matters when you are not. Nadia, the 1.7% annual timing gap. Source: Morningstar 2000-2003 is not a measure of investor stupidity. It is a measure of a system designed to generate decisions in moments where no decision is the correct answer. The gap closes when the architecture removes the decision from the moment. Maya, your direct debit does not know it is April. It runs on the 1st. It buys at whatever price exists on the 1st. Over time, that is the strategy. Not the days you checked 17 times, the days you let it run. Kai, the viewer question from the Bolt: how do you actually not sell? I asked all 4. The answer is the same from all 4 directions. You set it up before you need to make a decision. Then the decision does not arrive. If the crashing market question is something you want to go deeper on, episode 4 covers the full psychology and the DALBAR data in detail. That link is in the description. 9 episodes, 2 series, 1 direction. Series 3 begins next week. The same panel, new data, same commitment to telling you what the data actually shows. If this is the episode where something clicked, subscribe. New content every week. After the panel, I rang Marcus to ask one final question. He said he had given everything he was in a position to give. He then asked if I had doubled my monthly contribution after the market recovered. I said I had been thinking about it. Marcus said thinking about it and doing it were 2 different financial positions. He then said he was not in a position to advise on which one I should choose. The direct debit is still on its original amount. I am still thinking about it. Next episode is up there. Subscribe is over there. Both are better than whatever you are about to do instead. I know this because I have watched the next episode. I understand all of it. I have done approximately none of it yet. That is what the subscribe button is for.